Hi, and welcome to Wealthion. My name is James Conner, and today my guest is Henrik Zeberg. And Henrik has some very controversial calls for 2024, including a recession, which will be worse than 1929. And we're going to have a very detailed discussion with Henrik to find out how he establishes this severe correction. Henrik, thank you very much for joining us today. How are things in Copenhagen?
Things are great here. Still cold, but great. And thanks for having me on today.
Denmark is a fascinating country, and I would love to travel there someday. I recently read that Denmark just got a new king, and I was totally oblivious to the fact that Denmark even had a royal family. And I'm just kind of curious, are they as notorious as the British royal family?
No, that's not my perception of them. I think that they have done pretty well over the years. We've had a queen so for 52 years now, and she hasn't put a foot wrong, I would say. So it seems like we leave that to the British to do that.
So we're not going to see any documentaries on Netflix anytime soon.
I don't think so. No, I don't think so. So yeah, but we did have a new king. We got Frederick X. He became king here on the 14th. So it was a big event in Denmark. Half the country, turned up in Copenhagen, and streets were closed, and a fantastic event.
Oh, that's great. It's always good to have something to look forward to. So let's move on now, and I want to get your views on the economy. And there's a lot happening in the world right now, just in terms of geopolitics and also the global economy. And before we do the deep dive, I want to first start by asking you what most concerns you. Is there anything that keeps you up at night?
Well, yeah, I would say that I don't think people really understand how bad this can get. We are at the end of the money printing era, I would say. At least that is coming. And I am, the societal fallout from what we can see with a potential deflation first and later on stagflation could be quite severe. So that, doesn't keep me up per se, but it's something that I do worry about. Yes.
So you made a great call in 2023. You were bullish throughout, and now here we are in early 2024. Where do you see the U.S. economy going in 2024?
So for now, it's the economy is still strong. We see that the labor market has not rolled over. I have a business cycle model that I have been constructed with Swissblock Technologies, and what that shows us is that the leading indicators, which actually leads the economy to the next step, have been declining for the last 20 or so months, and the last time we saw that was before the financial crisis. So what we see is that the indicators that are telling us where we are going are telling us we are going to have a bad recession. And the coincident indicators telling us where we are right now is saying, well, we haven't seen the deterioration in the labor market just yet. So what I would expect to see is that kind of continuation of what we have now with a strong economy going into, let's say, mid of 24. And but from then on, I think we're going to see a strong recession set in. You mentioned that I think it's going to be worse than 29. I think, or during the depression, I think it's going to be the worst we have seen since 1929 in terms of the market correction and potentially also the fallouts of the societal fallouts.
And Henrik, maybe you can provide some more context on exactly what indicators you're looking at. You mentioned a number of the indicators that you're looking at, leading indicators, have been deteriorating for a number of months.
So these are the ones from the conference board, and these are well-known indicators. So you can go and you can look them up there. In the leading indicators, you will see housing permits, you will see initial claims, you'll see others. And these are actually the ones that will tell us, as I said, now the Titanic hits the iceberg and we're going to sink, but we don't sink immediately. And if you check those out, you see, if you look to the conference board, and we made a model, or we created a model based on those. And if you go back in time and you back test all of this, you will see that every time you get a recession signal from the leading indicators in our model for the last 80 years, you will actually see that they have never been wrong. They've never made a false signal, never an extra recession call or any, and it never missed anyone. So it's pretty strong. But this is not the only thing that I look at, but the leading indicators here are very telling in terms of what comes, and it's just about the economy, the real economy, the labor market to start rolling over. And another thing I follow is the housing market, obviously. And the housing market is so important for all of us. So when we see housing go up, we will feel, better off, well off, and then we'll start spending more. And when it starts to decline and we feel we get in trouble there, well, then we'll see the opposite, and we'll actually see a decline in consumption, which is then going to make the decline in GDP worse as well. And right now we see a worse setup than before the financial crisis. This much is very clear.
But I want you to be more specific now, because when you look at the economy, you mentioned it's very strong. It's at around, the GDP is growing at around 5% annualized. The job market also very robust. What indicators do you see that are telling you that the economy is slowing down and possibly rolling over?
So again, it's about understanding what is the steps in the business cycle. There are three. If you look again to the conference board, which is where we base our business model cycle model on as well, you'll see that the leading indicators that I just spoke of has been rolling over, then telling us. And if you go back in time and if you look at the model that we have created, you'll actually see how the top and leading indicators then lead to our top in the coincident indicators. But there is a lag. And everybody last year was talking about the yield inversion. And now it seems like to have been forgotten. But actually, if people just look, they will see that at the bottom of the yield inversion, and we still have a yield inversion, but from the bottom of that till the recession sets off, normally we see like 12 to 15 months. And this time around, the bottom in the yield inversion was in June of 23, which gives us around June of this year before we should see the recession sets in. But everybody seems to have forgotten about that yield inversion now, because now things are going well and the market is up and all that. And as you said, also the labor market as well. But what people do not understand is that the labor market is kind of a lagging thing on the whole economy. One of the things that I'm sure a lot of the viewers here, and I can feel myself also, that we've been hit by, is the rise in personal interest payments. So rates have been going up, market yields have been going up, and this is the iceberg. This is the very definition of the iceberg. So they have been rising. The personal interest payments have been rising faster than we saw before the financial crisis, before any crisis we have seen for the last many years. Like I don't even have data to see how far that goes back. And that is, as I said, the iceberg, because what people then do is that they will start to cut back on consumption, on spending, because they want to meet their, and pay their mortgages simply. I mean, we're just human beings. And that is what will slowly get through the economy. And we have never seen a spike like what we have seen this time around. And again, we have never seen, all the other indicators that I follow. These were just two of them: yield inversion and the interest payment spikes. And there are others. I have 17 recession indicators that will actually tell me, first of all, when we'll get there, but also tell me that we are already seeing that slowdown. Is it visible to everybody now? No, it's not, because people will be looking at the market and they'll be looking at the labor market and the housing market, but it will become visible. And I honestly do not understand, that we have, famously or known, economists and people out there saying, "Oh, we will see a soft landing." I can promise you, you'll not see a soft landing. You'll see quite the opposite.
Okay, so you brought up interest rates and the pain that higher interest rates are causing to the average consumer. So let's spend a little more time on this. And the market has put in a massive move since the end of November, the beginning of December, all based on the expectation of interest rates being lowered. And we have another Fed meeting coming up at the end of this month. What are your views? What do you think the Fed's going to do at the end of the month? Are they going to maintain rates as they are? Are they going to cut rates? What are your thoughts?
I don't think they're going to cut. I mean, they're not going to raise them any higher. They're going to, but they will do that. They will do the pause. That stands pretty clear to me. despite the fact that we are actually seeing the 2-year market yield coming down quite strongly, which is really their guidance. I mean, what guides the Fed, what drives the Fed is where they see the 2-year yield, and then they will follow that pretty closely. So, but I think in terms because of the as we've seen also the CPI number coming out a little more hot than probably was what they wanted, then they'll not be cutting yet. Also because the labor market is as strong as it is, so there will not be a need for it, and they will still think, well, we need to orchestrate this soft landing, and we'll just the labor market is still strong, maybe running a bit too hot, so we'll keep the rates as they are at this point. But they will be cutting them, and they will be cutting them because they see that the market yields will be coming down strongly, and they will see a deterioration of the labor market. And if the leading indicators again speak for what we're going to see, the decline we're going to see in the coincident indicators, meaning the labor market and employment and so on, will drop very, very dramatic, into, let's say, June, July, August of this year, and that's the time when I think so. The last of 24 will be all by cutting from the Fed, but they will be a little late because I'm not sure that they really understand the kind of severe blow that they have caused to the economy. The dynamic effects of the economy, where when you start to see inflation, will put a damper on the inflation by itself. And the Fed seems like they think they need to do all the work. The work is actually done by the economy. What they have done by moving the rates up as aggressively as they have is to cause even more pain to the whole situation. They have they have made the hole in the Titanic even bigger. So I mean it's going to sink, and it's going to be deflation when a year out from now. Deflation will be in the books, not inflation or anything like that. It was, as I put many times, it was transitory inflation. The Fed thought that they had let the inflation genie out the bottle. What they really did was that they have made a spike, and that spike would have corrected itself. But now we are standing with the damages of the high rates that they have been causing.
So let's talk a little bit about inflation, because the reason why they took rates from 0 up to 5% is because they're trying to get inflation under control. According to the CPI, it got as high as 9% last year, and now it's around 3%. But I think you and I probably both agree the real rate of inflation is a lot higher. I think myself, it's probably 10% or more. And this is also really killing consumers. I mean, you take inflation in conjunction with taxes. Taxes are your single largest household expenditure. And then you throw on this double-digit inflation, like you're causing so much pain to the average person, right? And so what are your thoughts about inflation? Do you think inflation is a whole lot higher? And is it going to be a reacceleration of inflation that really takes this economy down?
No, actually, I don't think it'll be a real acceleration of the inflation. I think there has been a spike, which is causing havoc and damage throughout the economy, as you rightly put it. And whatever level is that, I don't know. I mean, obviously there are some ways of correcting or calculating this. But I think if you look at to truthflation, as they are called, I actually follow them also for the components of inflation and the development of inflation. I think that they come up with a pretty good piece of or of a calculation for what the current inflation rate is at. And I don't have any better tools than that. But you're absolutely right. The damage to the consumers from inflation, from interest rates, from everything we've had hasn't been felt altogether just yet. It is something where it needs to get through into the cycle. It means that we need to start to see the layoffs in certain companies, and then that will accelerate, and then people will really feel that they are underwater because they are they have these high mortgages and what else. So I think it's about understanding that it doesn't happen immediately. And so all we talked about when inflation was going up is still here. It's still making its way down through the so to speak the funnel, or the whatever, the down to the into the consumers, and the way that they spend money and do not spend money. And you see that on luxurious goods. I mean, luxury goods, they've down because people that's the first thing you'll cut away. You do not buy that very expensive watch or whatever it is. But really down to just, the simple setup for the customer, the consumer. How do they feel? What kind of pressure is on them? And right now, as you say, it's huge, and it is causing the Titanic to sink at some point. It just doesn't happen immediately, as most people. I don't understand why they keep believing that or thinking it should happen immediately, but because it's, if you just go back in time and check history and look to the charts, you will actually see that this is a very normal cycle we have.
You're right. You made mention of the fact that a lot of these higher wages are still percolating through the system. I read recently that there was 22 major strikes in the U.S. during 2023, a major strike being anything with over 1,000 employees. And a lot of those contracts that were negotiated are still making their way through the system. And this could also lead to further inflation. And another issue that you brought up earlier, and I just want to touch on again, is housing affordability. It doesn't matter if you're in Copenhagen or Toronto or wherever you are, the price of housing has just gone stratospheric. And as you know, I live in Canada. It's a very, really small country, a population of 40 million people. Our government brought in over 1 million people last year, half of which came to the city of Toronto. So that's an additional 10%. You can imagine the pressure that's putting on the infrastructure, on housing, and so many other things. What are your thoughts on housing affordability and what this is doing to the overall system?
Well, I mean, housing affordability hasn't been as low since the 1980s or something like that, and it's way below what we had before the financial crisis. So obviously, it's going to make its way into the economy. And thinking otherwise, I mean, when I hear people saying something along the lines of that AI will help us, or that, liquidity will help us. No, because this is about the real economy. The real economy is about, do you have a house, and how much is it, valued at? How expensive is it to live in it? And do I have a job? And these are the two most basic things that we need to look out for. Everything else is, pretty much Wall Street chit chat when you have this about liquidity and what the central banks will do and all that. Really, by the end of it, is what the consumer, how they feel. And right now, the consumers, the housing affordability, they do not feel good. The consumer sentiment is not good. And I think it'll become even worse when when you see unemployment rates coming up. We still have to remember, unemployment rates at this moment are at historic low levels. So if they go up to normal levels, it will start to be felt, and there will be an add-on effect on this. So I don't understand the people that can look at what you just said here, also with housing affordability and with everything we see with interest payments and the like, and then say, well, you know what? I think the Fed has got it this time around. They will actually, make sure that we don't have a recession. I can promise you that was what they said also before the financial crisis and before any recessions we have had. They will always say, "We got it covered. We know what we know." We all remember Bernanke stood in 2008 in January and said, "Well, I don't see a recession at this point," and we were in the midst of it. So this about having faith in the central banks and the Fed and so on, in them manufacturing or orchestrating a soft landing, it's not happening. What we see is exactly as you said, housing affordability and the hit on the consumers from every sort of way is what will cause this cycle to really end in a bad way. And we have to also understand that there is a supply side to it as well. So we're talking demand here. The supply sides are the companies of the world. Where they had a fantastic 21 after Corona. We had all the stimulus coming out, and everybody was making money. And if you look at the retail's stockpiles that they have right now, the inventories of retailers and the likes, well, they are 16, 17, 20% above, the long-term rate or average. And that is the highest it's ever been again. And that will tell us that somebody needs to reduce capacity because it's not needed. And if you have been adjusting your capacity up to meet the kind of demand we saw coming out of the Corona crisis, well, you probably tried to you're ambitious because you thought you were doing well, but actually it was just a boost from every central bank of the world and every administration of the world, which of course caused a lot of demand. That demand is now pulling back, and you'll see supply needs to do the same. And that's why the deflationary part is coming. That's where we're going to see price decreases. And in my setup. And what I look at, I see, a setup where we'll have the worst deflationary bust. And this has come back to what I said before. It is since 1929. I don't think it's going to be as bad as the Great Depression, but since 1929, in terms of, that we're going to see a deflationary bust, which will be with high negative inflation rates.
So before we discuss deflation and where you see prices going, why don't we just summarize a few of your concepts? So first of all, we have this stratospheric inflation. That's resulted in this acceleration of interest rates, the fastest increase in interest rates that we've seen in economic history. And this is causing a great deal of pain to the consumer, and eventually it's going to hit businesses. And this is why you think the economy is going to pull back or contract. Is that correct?
100% correct. That is 100% correct. That is the business cycle as it exists. That is how it has been working for years and years. And that is why when you look at the leading, coincident, and lagging indicators also, and you will see that there is a very nice, it's like a Swiss clock. You'll simply see how it works its way through. And as I see it right now, I'm being asked, but what will change your mind? I'll say at this point here, there are so many indicators I have seen. There's no way it's going to change my mind. I mean, at this point here, if we are not in a recession by in a year's time, well, then I'll have to reevaluate. But I think it's more likely that we're going to see a very strong acceleration because of the things you just mentioned there into late part of 24.
So let's examine your scenario in more detail and what it's going to do to financial markets and also this whole concept of deflation. And why don't we just start with the S&P? It's currently around 47 or 4,800. Where do you see the S&P going up until June when you think the economy is going to start slowing?
Well, I have this, outrageous target, which I've had ever since October of 23. And I said when it's 6,100 is still my target around that level, based on the technical setup that I see based on Fibonacci extensions and so on. And I know it's a very, very strong move going into to June. Very, very strong move. Could it last a little longer? Perhaps, yes. And I would think also that the U.S. markets would be the last standing. We normally see that we hear in the media that, well, the rest of the world doesn't look too good, but we actually see that the U.S. is doing well, and the old U.S. will make sure that the rest of the world doesn't fall into a recession. That doesn't happen, and again, it's always the U.S. that then follows the rest of the world. But I think we will, into June, mid of this year, let's say, we will see a very, very strong move in the markets. It will accelerate and become even stronger than what we have seen in last year. And that is the normal behavior also, as we see now people thinking, the narrative is out there already. That's what we're up against now. That is that, people saying the soft landing is here. We believe in the soft landing. And Henrik, just see, you called you called the rally and you got it. And that is actually telling us that we are getting into a new business cycle and we're moving higher. And it's a new bull market and it'll go on for the next and until 2030 and whatever. What we're seeing is the normal, narrative now developing from very pessimistic because we have had an inflation spike, and then people are getting back in saying, "Wow, let's party." And I think when we start to see, significant levels above all-time highs on the S&P, which we'll see soon, and the same with the Nasdaq, where we are already at all-time highs, and when we start to see the crypto rally, which I think is, we've seen Bitcoin, but I think Bitcoin will go up a lot more from here. And I think we're going to see altcoins, joining, not only joining the party, but actually, develop into a larger euphoria than we had in 21. Well, if you see all of that, it will be very difficult for people to stand in the midst of that and have earned a lot of money and still understand that the business cycle is actually rolling over. So 6,100 on the S&P, 27,000 on the Nasdaq, maybe even 33,000 could even also be the case for Nasdaq. I'm a little in doubt there, but a lot higher from where we are. And even as we start to see some of the Nikkei, for instance, getting closer and closer to my target of a very, very big top as well. So I think there will be some foreign markets outside of the US which will do not so well getting into, let's say, April. But I think the US markets will stand for a little longer, and then we're going to see the decline. And it will not be felt on the first week and the second week. But I think by the end of this year, we will definitely have felt it. And I think also the Fed will start to react to that when we start to see, levels, or the markets really declining strongly.
So just to summarize, you see the S&P going from the current level of 4,700, 4,800 up to 6,000, 6,100 by June, which is a move of 25 to 30%.
That is, I know it sounds strong and fast. I know, but if you look at the current, slope on the curve, so to speak, I mean, it's a continuation of that. What we have seen ever since the October lows, if you continue that, it actually shows us that that could be the pace we could be expecting. And the next level here, I'm still expecting that when you see all-time highs coming in on the S&P and it stays above that, I think the buying, the push will come from there, because that seems like that is when people will start to understand that this is going much higher.
And so you touched on Bitcoin, and we have to bring that up because that's strongly correlated with the S&P and the NASDAQ. And so it's currently trading, I think it got up to $48,000 ahead of this ETF announcement by the SEC. It's pulled back a little bit, but where do you see Bitcoin going between now and June?
My targets are still around 115,000 as a minimum, maybe as high as 150,000. And again, it sounds like a crazy move with the amount of time, but that is normally what we see also going into. And again, we have to understand and remember that we are in exponential times in terms of when the party gets going, it really gets going, and that's where we start to see the whole FOMO develop and so on. So I think Bitcoin at 115,000 would be my minimum target to be reached around that time.
Yeah, I'm one of those people. Every time I look at Bitcoin, I have FOMO.
Yes. Yes.
So I might be getting involved here in the next few weeks, is what I'm saying.
Okay.
So we talked about the S&P, we talked about the NASDAQ and Bitcoin. What about gold? What do you see gold doing in this current environment?
So I know I've famously been called out that I didn't get my gold call correctly, and yet we haven't seen gold rallying to 10,000 or whatever the gold bugs have been saying. I am myself a gold bug. I think gold has a big place in the monetary system, but there's good times and there are bad times to hold gold. And bad times will be the times where you see liquidity crunch. That's the time where there's a purpose why there's a reason why gold is what you're supposed to hold. Is because of the long-term trend. You have inflation, of course, but in terms of crisis, you need to have liquidity. You need to be able to pay off your debt and what else, and you need simply to liquidity. US dollars is what you want to hold there, and to get that, you probably see gold and silver and miners getting sold off. So I'm very bearish the precious metals at this point here. Could we see gold reaching 2,500 before we get there? Potentially, yes. But do I think we will? No, I don't. I think we actually have seen the top, and I think gold is trending lower from here. But again, could I be wrong on that? Potentially, yes. But I still think at 1,200 to 1,250 would be the bottom around that level for gold. It could even develop to lower levels, but gold is going to decline and crash into a liquidity crisis, and we saw that also during the financial crisis. We saw from March of 2008 until September of 2008, we saw gold declining 33%, and we saw silver declining 60%. So I don't understand why people are just saying, oh, well, we need to hold gold because a crisis is coming. Actually, you need to understand when there is a crisis, you don't want to hold precious metal, you want to hold liquidity, US dollars, and then you want to get into that when the Fed steps back in. So it's about the timing of that, and people again can just look to back in the times, and they look into the deflationary bust we have had. Well, you'll see gold do not do tremendously well there, during those busts.
And so just to clarify, you think gold has already topped out at around $2,000 an ounce?
As I said, I'm not trying to time that. I'm trying to time when we see the bottom. So, but I think there is a chance we could have seen the top in gold at this point. Yes, and we'll see the decline into around 1,250, whereas there will be a rather strong decline. I mean, the deflationary bust that I see developing is going to be very, very strong. I don't know how I can put this. This will be, days of minus, 5, 6, 7, 8% on the stock market. Uh, we'll see the stops on the market. We'll see markets taking a pause and all that. And I think there will be a lot of panic. There will be a lot of panic for crypto enthusiasts, and there will be a lot of all this. And again, gold will not do well in that environment. The environment where gold will do well is when we get to the next phase, is when the Fed steps back in, not just with rate cuts, but comes up with another fantastic solution like printing money again or doing something else, and then we'll see what gold then does. Because then I think we can easily see gold at 10,000, but there's another bottom coming before we see gold going to those levels.
So the gold bugs have had a very tough few years. So you're saying it's going to get a lot tougher for them?
Yeah, I think it will, and I think there'll be blood in the streets before we get to the point where gold will be to pick up again. If you are a long-term investor and you say, well, I can sit through a crash from current levels to 1250, that's good and fine, because gold will come up again and it'll do so fantastically fast. But if you look at it and you analyze, you want to be long gold when silver is leading gold or miners are leading gold, and you don't see that. You've seen actually miners and you've seen silver are down a lot this year. They're down a lot since 2011. Gold is the only one who's made a new high on it, but that's normally not a good sign for the gold market. You want to see that silver is leading gold into new highs, and you want to see the miners leading it. And so right now we are in a bounce. I know that sounds weird, but we are in a bounce from the first decline we had in the gold bear market that started in 2011. Then we have seen this bounce into 2020, which was higher than 2011. I get that, but the next decline is going to be the worst, and I think that's where people will, we need to hear people saying something along the lines of, gold will never have its role again, and all these things, and then it's time to get in. And I want to see also that we start to see, the recession is clearly and there, like what we saw in when we have some of the black swans events that I expect into the deflationary bust. That's when we should start looking at gold.
Yeah, you're right about these gold miners. They have been horrendous here in the last few years. And even if you look at the price of gold here and the move we've seen in the last few years, adjusted for inflation, it's still very disappointing. And then when you compare it to something like Bitcoin, oh my God.
Yeah, exactly. And I think you can see Bitcoin will go to 100 times the value of gold before we get to the bottom of gold. And again, that's because we need to understand. And again, that comes down to the talk about Bitcoin becoming the new gold. That's not what we see right now. We see actually the opposite. We see that, Bitcoin is something you get into when you become really risk on, and you want to, you want to be part of, a risk on rally. And then you see gold is not tremendously doing well, not so well there. And I think you will see that there is a time for gold. That will be when we get to the into a recession and the Fed steps back in, where I don't think Bitcoin will do tremendously well. Actually, I think it is going to have a very really tough time. So again, there will be different times for this, but Bitcoin is not a new digital gold. I mean, it's not behaving like that. Let's put it like this.
So we have to talk about oil. This is a big driver of any economy, and it's been very volatile the last few months. Topped out around $95 a barrel. Now it's trading in the low 70s. And this is in spite of everything that's happening in the Middle East and also Ukraine. But what are your views on oil in this deflationary environment?
No, I mean, oil is the driver of inflation, and if you have a deflationary environment, you will see oil coming down strongly. And I wasn't too surprised to see that oil turned when it did. I wasn't too surprised to see the decline we have seen so far. And if we take it from the 100 and what was it, 130 we saw back in mid of the last year, I think it is. Well, we down now at 70 something. I haven't looked at it today. And well, that I would say is normal. What we saw back then was the spike because of the artificial created bounce and spike and the huge amount of stimulus coming out into a supply crisis. Then you see oil coming up, you see inflation rates coming up. But now you see oil down again, and I think you're going to see it decline much more. And I still have a target below $10 going into the deflationary bust. Will it be as bad as during the Corona crisis? I don't know, but and I also had a target below $10 before, from 2019 into. I didn't see the Corona crisis coming, but I did see a crisis. I did see a creation, a recession coming, because again, the business cycle indicator told me that this time around it's going to be a bigger deflationary bust, and oil will do not well because oil will do well when you see the economy is flourishing. And right now, at this point, it'll come to a not a standstill, but it's going to be bad times in the economy, and that means that the oil will go a lot lower. And I say below $10 will be my target into the deflationary bust.
And where do you see oil going from now until June when you see the market topping out or the economy slowing?
Yeah, so I there are two ways actually, and this is easy. Either it goes up or it goes down, right? So that's very easy. But there is, in terms of the technical model I have, it's there could be a bounce in, but I don't actually. That's not my favorite thesis at this point. I actually think it's just going to decline, and it's there are some levels it needs to break through at this point, as I remember it, and I think when it drops there, there will be a larger decline. If I look at the market yields, we are in for a huge decline in market yields, which could set in by, let's say, March, April, something like that. And I would not expect to see that unless I also see a decline in oil. So I think there will be a larger decline there, and then again the bounce at some point, and then the final decline into my target. But again, I am short term. I could see two roads here and two paths, but my favorite scenario is actually that we do not see much more of a bounce, and then we just continue lower.
Yeah, it does appear to be very weak. So, okay, so let me just summarize here what you are suggesting investors do. From now until June, it's risk on. So stay long the S&P, stay long the NASDAQ, stay long Bitcoin. But then when the economy starts slowing and we start getting this pullback in all the financial markets, how would you suggest, or what do you suggest investors do to profit from this or protect their wealth?
So there are different ways to do that. Obviously, first of all, you need to have liquidity. You need to have the US dollars. That's not the time now because I still have a target which is around Dixie for 90 for on the Dixie. So I don't think that's the time now. And so that will be the risk on phase. But when you get to the bottom of that, you need to hold liquidity. You need to have cash. And cash will absolutely be king at that point. I mean, that's when the markets are dropping. Just holding cash at 0%, would be good, or even a positive, rates. And there are ETFs out there you can invest in, going against the euro versus the dollar, which will be one way of doing it. And also TLTs, US bonds, German bonds is something that I hold as well, and start to scale more and more into. I see the TLT can move from the current levels around 90, what is it, around 98 or something. I'm not really sure, but then I think we can go up and we can see a level around 200 of that. So I think we can easily see a doubling of those prices. So TLTs will be good. That's during the deflationary phase. And then also you can short the markets but that's of course more risky, and that you need to have the stomach for that because there will be a lot of volatility. I will go against the herd again when we start to hear that Bitcoin will hit 1 million or 2 million or whatever they come up with. I think shorting Bitcoin at some point will be a fantastic opportunity, and the Bitcoin miners, and what else we can do. I mean, there are so many opportunities there on the short side of the market, but that of course is more the risky game. The more safe game will be to enjoy the rally in the market, understand that there is a time, that there is an end date to this, and then understand that you need to have liquidity. You need to be into TLTs and US bonds and German bonds and the likes, and then stay safe there. And understand also at 0%, will be a good return also sometimes, or even low percent. But that will be difficult for people to understand who have come from this, that I'm doubling my money on crypto in 1 or 2 weeks, and then you have to settle with small percentages going into a crisis. So a lot of people will be caught on the wrong side of this. And that is just unfortunately the history and the nature of things. And when I talk about this with a recession now, I can start to feel that people are in disbelief even though I would say the signals are clearer than what we saw before the financial crisis. So I think it's weird to see that people do not understand this with the business cycle. So, but there are ways to hide out and to make sure that you don't lose your hard-earned money.
So, Henrik, most of our discussion has been focused on the U.S., the largest economy in the world, and why don't we touch on China now, second largest economy in the world. And of course, we never really know what's real and what isn't coming out of China, but a lot of the narrative, a lot of the commentary we've seen is that there is a definite slowdown there, and there's issues with the real estate market, both residential and commercial. Do you have any thoughts on China and what this might mean to the global economy?
So I think that China is is in big problems or troubles. I mean, absolutely. But there is many other places around the world. I don't think Europe looks fantastic either. And I mean, actually, I think the U.S. For now looks better than most other places around the world. So, but China is obviously have problems, and they have tried to create this phantom or this mirage of a continuous growth, and by building, manufacturing the largest property bubble in history, and now we see the consequences of that. I mean, the consequences is that at some point, people are not going to move into those properties, and they have to tear them down again, and that means that the financial growth that you saw, sorry, the economic growth you saw years back, was actually artificial. I mean, no surprise to anybody, but it's just because it's been going on for such a long time. So China will be in trouble, but I think a lot of places around the world will be as well. And we can just hope again that this will not create some outfalls in terms of, as I said, societal outcomes or geopolitical situations or anything like that. But I do fear, and when you ask me what keeps me up at night, this is one of the things. I mean, because when you start to have a large economy like that, where you have so many people moving into the middle income class, and then they will start to see that they actually maybe lose that status again or starting to become poorer again. Well, they will want to see action. They want to see something getting done by it. So I think China is an example of what not to do in terms of how to create growth. First of all, second of all, well, it will show us the way for how bad things can be. But again, they will not just let this go, and that's why I think there's another go in terms of the market as well. Also, and I see people now saying get out of China. I'm not too sure that you want to get out of Chinese stocks at this point, and you actually could see a huge bounce in the Chinese stock market and indices going in again to the next 6 months here, because you'll see the dollar pulling back, and well, what else we see. And I think a lot of the hype we're going to see in crypto and the like is going to come from the Chinese central bank inducing a lot of money again. So we'll see a lot of liquidity coming in from that as well.
So you're very positive in the short term, risk on between now and June, and then you become very negative, okay, and then it's risk off. Now, if there was something that might derail or change your thesis between now and June, so maybe you don't foresee this major correction in this deflationary environment, what would it be?
Well, there are two ways. Either it goes faster, or we don't see the recession at all. And if it needs to go faster, well, I could be mistaken on how fast it could go. I mean, how fast we could actually get to it. And when I say June, I think it's already a stretch in terms of when we see the market top. But let's go with June. I think June will probably be the month of the beginning of the onset of the recession. So, but in terms of not seeing it, if we're going to get into, we will not see the recession, and the people calling for a new bull market, a new economy just keeps on growing here. Well, what do I need to see? I need to see my leading indicators in my business cycle turning positive immediately, and I need to see a bounce in the coincident indicators at this point. But that would be a first time in 80 years, so I do not expect that. It would be irrational of me to expect that to happen. But that would be needed to see. We need to see that the dollar starts to decline and then actually stay low, and do not begin the rally. I expect after the Dixie reaching 90, which is my target. Well, then I think a dollar rally will come, which will take it to 120, in that region, and that we cannot have, because if that happens, then you will have a deflationary bust. So I need to see the dollar continuing down from here, and unfortunately also not what I see. So I think it's very much baked into the to the cake here. We got what we got. We have tried to counter a supply crisis by pouring money onto it and creating demand, and that has created a new situation. And now we'll have to live through that phase. Unfortunately, I mean, because it will create a lot of challenges for people and havoc in the economy. So I don't like it, but I have to look at what I see, and I got so many indicators telling me that a recession is coming. It's not here yet. It's not here yet, and I want to emphasize that, but it's coming. And with Europe looking as subdued as it does already, and China, as you also mentioned. So where you're going to see it come from if all of a sudden US is starting to decline as I expect it to. So but leading indicators moving up and the Dixie keep falling and declining and staying low would potentially change my mind, but I just don't see it coming.
When I hear your targets, I don't think they're outrageous. I mean, the S&P was up 20% in 2023. The NASDAQ was up 40 or more. Bitcoin was up 170%. And a lot of those moves came in the last few months of the year. So I think your actual price targets are not outrageous. The one thing I would take issue with would be the timing and how fast it's going to happen.
Fair enough. And timing can be difficult, and I could be on the show here in 6 months time and saying, well, maybe a couple of more months to go. And I talked to Raul the other day on Ran Neuner's show, and I said, well, I think if you do an interview again in a year's time, we will definitely see it. Again, the timeline of the timing of it comes from what I see in the, let's say, in the yield inversion, for instance, and other things. So, but I haven't seen the deterioration in the labor market yet. But that can come really, really quick. That's what I want to say also. So when I don't say there, when I say there's not a recession yet, and I've been surprised also to see the strength of the labor market, but that can turn, unfortunately, rather fast because all the leading indicators are telling me so. And they have been down, as I said, 20 some month, I think it is now. And that up to the financial crisis, they were down a similar amount of time before we saw that kind of crisis unfold. So we are getting, it's the upturn of the market move higher, and the economy, strong economy is getting long in its tooth. And I think we will, the deterioration will come through the indicators, or through the examples we talked about with housing and with the personal payments and so on and so forth. But I hear what you're saying in terms of the timing, and time will tell.
So I want to ask you about your comments about 1929. You have said that the resulting pullback is going to be similar to or worse than what we saw in 1929. And I just want you to clarify this, and just to provide some more context to our viewers. The Dow peaked in September of 1929 at 381. It bottomed at 41 in 1932. So that was a pullback of 89%. But why do you think it's going to be like 1929, and why not 08, 09?
So I say, again, I say since 1929. I just want to emphasize that. I think it's coming up quite a few times, and I need to say that it's since 1929. But it's actually based exactly on the way what you're looking at there in terms of the decline and the size of the decline. And if I look at the S&P, I can see a market decline going from 6,100 to maybe between 15 to 1,800, so 1,500, 1,800. And if you look at that, that's a sizable decline. And then people say, yeah, but that's not so bad because you're actually seeing, we've been going up so much over the last couple of years here. And then I'll say, exactly. And that's why you say the percentage decline will take us back to 2015 or 16, which is not so bad. But that's the decline I see in the S&P. If I look at the small caps, I see more of a 80, 90% decline in those when we get to the top that I expect. So not from current levels, but from the top that I see. And also, if you look at elsewhere, and one of the things that I do not understand, people also maybe miss out on here, is that, well, we have a crypto market also where I think a lot of the devastation will come from, and I think that if I'm right on the size of the from at the top of the peak here, coming peak, well, then I think that there will be a 4.5 trillion crypto market, maybe as high as 5 trillion crypto market. And if that is going to be almost, you know, decimated as a minimum, but, maybe cut down to barely nothing. I see Bitcoin declining a lot, and I see some of these cryptos, getting annihilated. Then you'll see a lot of money falling out of the system. I see a lot of startups, business startups that we've seen over the years. Everybody has been searching for yield. If you're a private equity fund, you've been, pounding the table and saying, why can't you find yield? Find yield for me. Go buy this company and what else? And we have seen these, outrageous valuations on companies across the globe. And that has been running for some years, but some of these businesses simply do not have a sound business case. So all of these, I mean, the whole misallocation of money, which comes from too low interest rates, and we don't have that right now, but we have had it. And if we get down to these levels again, in a recession, is going to come, to make sure that that the whole situation comes home to roost, because the fallouts will be that there will be no more funding money for venture money for the startups. Crypto money will be annihilated. You'll not have $1 million in your wallet any longer, and what else have you? So a lot of people will lose a lot of money. And what I also see, and you have to understand that I see a two steps to this. I see a deflationary phase, where the central banks will start to pour money onto it again. But the thing is, we have had the free lunch in 2008, where you could actually throw free money on it. What we've seen this time around, when we saw the Corona crisis, was that the real economy didn't really turn immediately, and it took it took a little while before we actually started to see the real economy making a move on it, and that's why we saw inflation coming up later on. So what I'm expecting us to see at this time here is that the real economy will actually turn much, much slower, and because pouring money on the whole problem is done because you want the central banks, they want us to start taking on loans again. Go take this loan, it's cheap, spend money. But if you've just gotten hit by high interest rate payments, interest payments, you don't want to put more debt on immediately. So it will take a while to convince the consumers to start spending again, even if you pour a lot of money on this. Liquidity will not work in the real economy unless you get that exact behavior out. And that is what people do not understand. So they'll throw money at it, and then you'll have the magic will work. No, the magic comes through the consumer. And if the consumer doesn't doesn't want to do it because he's unemployed now and he want to save his money, make sure he doesn't get in that situation again, well, then it takes time, and free money will not help it. But what we could see is that free money will then start to float into and chase other asset groups like commodities. And that's why I think you could get to a situation where the first phase will be a deflation first. You'll then see the Fed response, and then you'll see a stagflation unfold for a couple of years, because you will actually not see the bounce in the economy, and that you cannot stimulate you out of. We haven't seen a real stagflation for many years. We did see some of it coming through in it wasn't the stagflation we saw after the Corona crisis, but we did see when both stocks and bonds going down, we saw pension funds having a lot of problems, which is another thing I think we're going to see. Because if I'm right in my thesis, we're going to see exactly that scenario, which will just be much bigger this time, and you'll see pension funds having a lot of problems. And that will cause the double whammy, so to speak, in terms of this crisis. But this is a little further out. So we have to understand there is a deflationary bust, and of course you'll see the Fed coming back in. But how will the economy react to that stimulus? Will you, as an unemployed person, maybe you lost your home, God forbid, but still people will you then say, yeah, I want to take on that extra loan because now I want to spend money because the Fed tells me to? I don't think that's what you're going to see. And that's the real nature of the economy, which people do not understand. As I see it, that's the real business cycles.
No, you raised some very interesting points there, and we're all feeling a lot of pain right now with these taxes, exorbitant taxes, with double-digit inflation, and now we got high interest rates to deal with. And so it's going to be quite interesting to see how things evolve here in the next few months. And Henrik, as we wrap up, if someone would like to learn more about you and your services, where can they go?
Well, we got the Zeberg Report, where I, on a weekly basis, sit and explain about the market, what I see from a holistic perspective, meaning I look into all markets, so to speak, in the commodities and bonds and equities and cryptos and so on. And I draw up this holistic picture of it where all these markets needs to go in sync. And in order for me to have an outlook, then I create the narrative on that. And that narrative I explain on my weekly shows, live shows, where you can also ask questions on the show and ask for specific charts to be analyzed. So that's on the thezebergreport.com, and yeah, that's where you can hear more. And then I'm on Twitter. My handle is at Henrik Zeberg, and yeah, that's where you can hear more about my thesis, my outrageous thesis.
Well, I really enjoyed this discussion today, Henrik, and I want to thank you for spending time with us. And we're going to have to do it again later in Q2.
Absolutely, and thank you very much for having me on today.
Well, I hope you enjoyed that discussion with Henrik Zeberg. You might not agree with a lot of his calls, but that's what makes a market, is a difference of opinion. Some people are bullish, some people are bearish. And if you have any other suggestions on who we should interview on Wealthion, please let us know in the comments below or send us an email. We would love to hear from you, and we're always looking for new ideas. If you are trying to figure out how to prepare for your financial future during these uncertain times, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com. After providing some basic information, Wealthion will put you in touch with a vetted advisor. There's no obligation whatsoever to work with any of these advisors. It's a free service that Wealthion offers to all of its viewers. Don't forget to subscribe to our channel, wealthion.com, and also hit that notification button so you can be kept up to date on future events. We have some amazing content coming out in the next few days and the coming weeks to help you prepare for your financial future. Once again, thank you for spending time with us today, and I look forward to seeing you again soon.